Well, hello there. Good evening. Martin North from Digital Finance Analytics here. Great to see you. Great to have you on board. And it's fantastic that you've chosen to spend a little bit of time with me tonight. I've got so much to share with you this evening, so it'll be hopefully a really interesting show. Just a few things, I guess, to cover before we get going. Just in terms of what we just always go through, I will just make a few of these points, if I may. This is not financial advice. I'm not qualified to give financial advice. This is very much my own opinion. Please also play nice in the chat room. No racial slurs. The stream is being moderated, and if people mess around, well, we'll deal with it. But I also encourage all of the dialogue in the chat. I think it's part of the experience. This is as of today, the 16th of June 2020. If you want to get my attention, please use the world, because there's always so much going on that it will be very hard to see everything without it. And I've enabled Super Chat for two reasons. One is so that you can make sure that your question gets right up there at the top. And also you have the opportunity to make a contribution to help DFA do what it does. We don't make any money out of this. This is very much just covering our costs. So if you want to help cover our costs and support us in the content that we make, then you'll be very welcome. And Super Chat's when we're doing that. So without further ado, let me go through to the presentation part. And what I'm going to do is I'm just going to go through a few slides at the moment. So I'm not going to look at the chat at this stage. So if you've got burning questions for me, hold off. There'll be plenty of time later. But I just wanted to go through a few points. The first one is just so that people understand, particularly if you're new, how we come to our modeling. And there was a very interesting question that the Oracle asked. I'm just going to try and put it up on the screen if I can. See, there you go. Hey, the system works. So Oracle asked, it's a sample. Most surveys have about 1,000. We've got 50,000 samples. Yep. That's all absolutely right. And I'm just to explain that now. So essentially, we survey households, and we have 1,000 a week. That's 52,000 a year. And that's a 0.5% sample. And that includes a lot of information about their profile, their financial footprint, and aspirations, and those sorts of things. So it's part of what's called an omnibus survey, which is effectively quite a bulky, long conversation that people have. It's phone-based. I don't make the calls personally. I pay somebody to do that. I also incorporate information from other sources, like we survey SMEs. We also pull information from public sources like the Reserve Bank and APRA and places like that, and the ABS. We put it all into our core market models. That's the core engine of our analysis. And then the core market model is what we then use to power our client work. It powers all the things we do for YouTube and for our blog. And we also do custom assignments for clients too. So that's how it works. And this is probably the most up-to-date survey, because it's basically each week we get data in. So we're talking about information that came in as late as last week. And then we scale it up, because obviously population is a lot bigger than 50,000. But nevertheless, we scale it up on a sort of pro rata basis to give a national view. The other point, I guess, to make is that the household segments and other dimensionality that we have in our model allows us to slice and dice it like a Rubik's Cube. I can look at it by geography, I can look at it by segment, by property segment, all sorts of different things. And I'll show you some of that data shortly to illustrate how powerful the model can be. And we've been running this modeling now since 2000, so it's got quite a lot of history to it as well, which is also quite interesting. Now, here's an example. I just wanted to put this one up because this is actually the complete data set now available for every postcode that I can present today. And I just wanted to get down the list because there's a few additions from last time. So the first thing to notice is we have this is in the particular postcode, so it will be defined by a particular postcode address, and then it will actually have a label attached to it. It will also have a zone, so we have DFA zones. This is a CBD zone, so Central Business District. Then we have the number of households who are in that particular postcode. We know how many of them are borrowing at the moment. We know how many of them are renting at the moment. And then for those who are borrowing, whether they actually are in mortgage stress. Now we just find stress as a cash flow based analysis. In other words, money in, money out. If they've got a problem, then they're in stress. Severe stress means they're deeply underwater in terms of cash flow. And then we calculate the percentage. So we have a mortgage stress percentage. And the higher that percentage, the higher, the more concerned we'd be. The average across Australia is 37.5 at the moment. And we also calculate the risk of default over the next 12 months. So that's to do with mortgages. And then we look at rental stress. So this is the proportion of people who are renting, how many of them having cash flow issues with their rents at the moment. And then what the financial stress is, which basically is the combination of mortgage stress and financial stress, and also those households who are not borrowing at all. So that gives you an overall sense of the financial footprint of that particular postcode in terms of the financial stress. And again, the higher the stress, the more likely is the postcodes, the more likely is that prices will fall. Then I've also now got, this is new, the number of property investors in that particular postcode. So this is looking at it from the point of view of I'm owning property. Doesn't mean they own it in this postcode, it means they might own it somewhere else. But then I want to assess what proportion of them are stressed investors, and I'll come back to these definitions because it's quite important. So this is how many of them are effectively struggling, and also how many are severely stressed investors. Now, severely stressed investors, again, I'll come back to what I mean by that in a second, but it's giving us a sense of what it's like from an property investor point of view, and therefore what proportion of households who are property investors in that postcode, residing in that postcode, are actually stressed. And then finally, we have the number of investment properties. Now, of course, the number of investment properties won't correlate necessarily to the number of property investors, because the property investors may have properties in other postcodes. So that's why we have a different lens. So all those dimensions are now available in our model. And just to go through the stressed investor bit a bit more, it's much more complicated than owner-occupied stress, because that's all about cash flow, as I've said, both for rental and owner and mortgage stress. But for this, I define stressed if the property has been vacant for more than 2 months and or the rental flows are insufficient to cover the running costs of the property, which may include mortgage costs, management costs, maintenance costs, etc., and or owners have indicated a wish to sell because of stress or financial pressure, and or the property is in negative equity. And then basically I have a definition that simply says if you see multiple red flags, in other words more than one of those, then they fall into the severely stressed, whereas if it's one, it's just stressed. So that's essentially the way that I've got my system working at the moment, which is, I think, quite interesting. And it gives you a multi-dimensional view of what's going on. Now, we will get to some postcodes a bit later on through the day, as it were, or through the evening, but I just want to go back over a few more things. I want to touch on the RBA minutes. So this is from today. They published the minutes today, and they basically said that this is the biggest economic contraction since the 1930s. So they're not being backwards and coming forward. They're absolutely saying this is a problem. They also said that the retail sales has fallen sharply in April, consistent with a range of data sources. The contraction in spending in late March and April has been accompanied by significant job losses, with total hours worked down by 9% in April. So that sort of gives you another sense. And in fact, job numbers, hours worked, is probably a better measure than unemployment, because the unemployment numbers masked by job seeker. Then we can go on and say that they said preliminary indicators suggest business investments like to be flat, and in fact on capital expenditures there's a substantial and broad-based decline in non-mining investment over the following year or so. So this is now starting to talk not just about what's happened, but also looking ahead. Another reason why I'm quite concerned about the next little while going forward. Then they said that buyers' interest in new dwellings has declined significantly over recent months, and that's all to do with uncertainty about incomes, and the availability of finance has escalated. So what's fascinating here is at the time when the banks are more willing to lend, borrowers are a little less willing to borrow because they're concerned about their incomes and they're concerned about what's going on. So there's an increase in the supply of rental properties, a decline in population growth, and some existing renters have also received rent reductions. So they noted that under those conditions, it's dampened the outlook for dwelling investments once the current pipeline of work has been completed. So that's one reason why, of course, everybody is throwing stimulus at the property sector to try and bring it back. And then finally, the overnight cash rate has settled at around 13 to 15 basis points. Now, this is the rate between the RBA and our banks, not the cash rate. The cash rate's at 0.25%, but the true rate, the real rate of finance, is 13 to 15 basis points. So we're as close to zero as damn it. And that's one reason why I think it's highly unlikely that we are going to see much in the way of more rate reductions unless they decide to change strategy and go negative rates, which I suspect they won't for a little while, but they may be forced to later. So there you go, RBA minutes. The AFR today had an interesting article, and they said that 1 in 5 home loan deferred customers are in strife. So Karen Maley in the AFR wrote that according to the ABA, which I covered yesterday, there's around 480,727 approximately customers whose total borrowings come to $153 billion. And that suggests that about 96,000 borrowers with mortgages worth about $35 billion will end up in the bank's intensive care units. And of course, they've deferred repayments for a period of time. And so the question now is what happens in September when those deferrals fall over. Now, Kohler wrote, and I covered this yesterday, Kohler wrote that a lot of those may end up defaulting. Now, what's interesting is that she quoted one banker that said that they were sort of talking to people with multiple investment properties, suggesting that you probably want to sell one or two. And I agree with that. We're seeing a lot of property investors now running to the exits, and they are being forced a little bit by the banks. But bankers believe that the various steps that they've taken will allow people to sort of muddle through, and so they're not forecasting a cliff in September. And of course, part of the argument is, well, why would you force somebody to sell? Because if you do, then you've got a foreclosure to deal with. But on the other hand, you've got this 20% who look as though they've got issues. You've got another 20% who are fine and are actually now starting to make mortgage repayments. So this is a very important perspective in terms of the mix of behaviours. I'm seeing it in my data too. So we're seeing some households who are pretty okay, but unfortunately we're seeing a lot of households who are just struggling with the mortgage and struggling with the repayments and worrying about what's going to happen in September. So that's one reason why I still think that September is a bit of a cliff. Now, another dimension here, this is actually, again, from the AFR. Empty rentals in Sydney, Brisbane have hit new highs. The vacancy rate for Sydney CBD apartments blew out to 16.2% in May, up from 13.8% in April, and tripling the 5.7% recorded in March, according to SQM. And in Brisbane, the proportion of empty CBD rentals rose 2 percentage points to 13.3% for the month, more than double the 5.7% recorded a year ago. And in Melbourne, the CBD is 1 in 10 at 9.3% apartments were vacant, up from 7.6% in April. South Bank vacancy rate soared to 16.8%, which is a new record for the area. And Louis Christopher made the point that there's some interesting things going on here with Airbnb. So Airbnb owners now realise that they can't find the tenants in the long-term market. So they tried, and so they think there's around 120,000 Airbnb properties available for rent across Australia. In April, around 30,000 Airbnb properties were likely to be listed in the long-term market amid the lockdown. Now we're beginning to see that turning a little bit. So my data suggests that Airbnb people are making hard decisions. Do they try and get them back into short-term rental? Do they try and make them long-term rental? Or do they sell? And in fact, some of them have decided to sell as well, I think. So it shows you that the rental sector is also very much under pressure. So mortgage sector under pressure, rental sector under pressure. So if you want to have some logic as to why prices are more likely to go down than up, this is what you should be looking at. Now, the other thing that's worth highlighting, this is from CanStar, is that there's been massive, significant reductions in mortgage rates. So the lowest variable mortgage rate, which is actually from a company called Reduced Home Loans, is, wait for it, 2.19%. and the comparison rate's the same because of the way that it works. And then there are some fixed rate ones at 2.18%, but of course the comparison rate's a lot higher. So you always use the comparison rates when you make comparisons one rate to another rate, rather than using the headline quoted rate. But my point is, we've never seen mortgage rates so low in Australia, and this 2.19% is now the new benchmark in terms of the lowest of the low. And I'd also highlight that the best rates, the cheapest rates, are not amongst the big banks. So, if you've got a mortgage with one of the big banks and it's got a 3 in front of it, look really harder. You might even be able to get something if you have something with a 2 in front of it. If you have, and this is the point, if you have a reasonable amount of equity in the property. If you don't, very tough to get. But rates are dropping. And of course, rates are dropping also on deposits. So CBA cut their rates. Other people are cutting their rates too. So term deposits are just ridiculously low, as I discussed recently with CanStar. Okay, now there was a bit more good news from CBA, who said that actually the card data, the transaction data that they're recording through their system, showed a bit more activity. So it's bounced up a little bit. Remember, of course, though, that a greater proportion of transactions now are going through cards rather than cash. And that's partly because there's more online transactions, and partly because some businesses are preferring cards to cash because of COVID. And then they made the point that there's quite a divergence between households and furnishing equipment, which was up, but now dropping slightly, compared with recreation, transport or clothing, which is now up. And, moving towards, long-term average in terms of clothing, but recreation and transport still well down. And the final data point that they showed it was that by channel, the online is, significantly up from where it was, come back a little as in-store has come the other way. So their argument was there are a little bit of green shoot data here, and it may be true, but a lot of people, I think, less so as well, because many people don't have the money to spend. So I think it depends where you look and who you look to in terms of what's going on. Now, Westpac said that the payroll data was slightly higher. This is actually from the ABS. Payrolls fell 7.7% in April. That's a revision down from 6.1%. And this is basically high-frequency payroll data, electronic payments made to people employed by certain firms, mostly bigger firms rather than smaller firms. And they said there were some sort of promising small gains. New South Wales up 1.6%, SA up 2.2%. Victoria was down 0.4%. And we're seeing a little bit of uptick in some of those decline industries, particularly accommodation and food services, but arts and recreation continues to decline. And they also called out, very interestingly and importantly, second round effects, with payroll down in construction, 0.8%, and information technology down 2.2%. And that's something I'm seeing in my data, that effectively we had a lot of people in certain industries out pretty much at the end of March into April. Some of them are now coming back, but there are other industry segments that had a pipeline of work and were okay through April and into May, but their pipeline of work is now disappearing, and some of those are now putting people out. So we're seeing a bit of a rotation amongst different industry groups. And the Australian Chamber of Westpac Survey of Industrial Trends, quite a long report. I didn't put all of it up, you'll be pleased to hear. But you can pretty much see all the charts going down a long way. So if you look at manufacturing, the business cycle, the actual composite is well down. If you look at the general business situation, it's well down. If you look at wages expectations, if you look at profitability expectations, pretty much across the board, it's pretty flat. And the point there is that I think we have to look to the business sector, and particularly the SME sector, to understand what's going on, because while some of the bigger companies may be able to actually reinvigorate and get back, a lot of the smaller companies may not. And so I'm very concerned about what I'm seeing with my data. Now, the ABS came out today with their residential prices to the end of March 2020. I mean, this is a historical artifact, nothing else, because, of course, it's pre-COVID. And they made that point. The majority of restrictions relating to COVID-19 came in late March, so didn't really impact the statistics. But it's worth just noting the weighted average over the quarter was up 1.6%, up 7.4% over the year. Sydney up 1.9% over the quarter, Melbourne 2.1, Brisbane 0.6, Adelaide 0.4, Perth 0.6, Hobart 2.4. So Hobart left the way in the first quarter. Somebody asked me about Hobart, so there you go, mention of Hobart. Darwin was down 3.1 over the year, but up 0.7 over the quarter, and Canberra up 0.2. And you can see there was some significant rises. Now, this is, of course, on aggregate average. It's also using the CoreLogic data, and there's some interesting debates about the way that CoreLogic does their data, and particularly they've stopped the daily index, although you can still find it if you go to the ASX website. By the way, it still does exist, but not reported daily in their normal mechanism. So what this shows me is that there is, on average, some growth, but I have to tell you that within those numbers, even to the end of March, there was massive divergence between houses, between units, between different postcodes. Some postcodes were up, some postcodes were down. So this simplistic view of what happened to home prices doesn't really help you much. You need to get granular, you need to go to postcode level and to look at what's going on there. And it's actually quite difficult now to get really good postcode level information about what's happened to home prices. It was interesting that realestate.com.au said we've got masses of people coming and looking at our site. Well, of course, people want to know what's going on in property. No surprising, but it doesn't necessarily mean they're going to actually buy tomorrow. So just be careful about the way that spin is presented as effectively an argument for a rebound in the property sector. It may not be. It simply may be people trying to find out more information about rental or about property price values. And the REA is one of the few sites where you can actually get postcode level information and trend information on properties. Okay, now onto the household financial confidence. This is my latest data on my survey. So it was up 78.8. It's still worth noting this is below where it was back in 2015 at 87.69. So we're still in negative territory, but it's definitely bouncing back from its low back in February. So that gives the good news. But what's interesting is if you look at our segment, so we have those who are what I call free affluent. So these are people with assets but no mortgages. They often have stocks and shares. They've seen a significant bounce back because the stock markets have done quite well and because they've basically seen some of their wealth come back. But those with a mortgage are actually responding less positively relative to that segment, and those renting somewhere in between. So it's quite interesting how these different segments are moving. And across most states, it all pretty much moved up a little. Actually, Western Australia moved up the most. It was the lowest. It's come up a little bit. And there are a few leading indicators in the West that maybe there are a few positives coming through, but unfortunately it's pretty limited, so it's hard to know. Older households saw a bigger improvement than younger households. A lot of the pressure in this crisis through COVID and beyond is actually among younger households. Not only are they more debt exposed if they've got mortgages or if they're renting, they're often in informal employment, and a lot of them have been put onto a job keeper or indeed switched to job seeker because they were in informal employment. So not surprising that some of those are more concerned, whereas those more up the age bands with perhaps a little less exposure to mortgages, more exposure to the stock markets, which of course have rolled back, are feeling a little positive. Job security, though, is still an issue. This is actually looking at the drivers of the index. So we're still seeing a very high proportion. 70% of the households are less comfortable with their job security than a year ago, which is a big number, 70%. Savings are under pressure, so about 60% of people saying I'm less comfortable with my savings than I was 12 months ago. And there are two factors. One is people have been raiding their savings to be able to actually maintain their lifestyle, firstly. And secondly, of course, the interest rates on deposits that I mentioned earlier on are very, very low now. So many people who are relying on deposits aren't actually getting sufficient through the door to be able to cover the costs. So that's why there's a lot of pressure on savings. And I'm afraid that we're going to see more of the same, I think. Debt is a problem. So we can see there that it's still sitting, above 60%. It's come back a little, and that's partly to do with repayment holidays. So those repayment holidays definitely are helping some households. So if you don't have to make your principal and interest repayments for a few months, that helps. What happens in September? And there's also a switch to interest only for some people as well. So there's a little bit of a sort of help there in terms of reducing the repayments, which is weird because, of course, a couple of years ago, everyone was complaining about interest-only loans and how risky they were. But now, no, take an interest-only loan. Take two. Feel free. A bit nuts to me, but there you go. That's the way it is. So there's the repayment story. Income is still falling. So this is actually real incomes. Now, we've had some people who's got a big kick in income because they're on JobKeeper and were earning less than they are now under JobKeeper. But there are other who've considerably the other way around and effectively are seeing their incomes drop. And so net, we've got more than 6% of people who are less coming in the front door than a year ago because of their incomes. And that also is including, for example, households with multiple earners, and one of those earners has now actually not got a job. So we're seeing quite a lot of that in the numbers too. And remember, this is a household view, not an individual view. Costs are still rising. Cost of living, is pretty much still very high. Come back just a tad, but costs are still high compared with last year. And net worth is still declining. So net, you take account of house prices, who are sliding a little bit now. The bounce in equities up a little bit. Superannuation still down a little bit. Net, the net worth is lower for about 68% of households compared to a year ago. So that gives you a bit of a flavour for what we're seeing. Okay, now just a couple of other quick ones. New South Wales has a problem. Paritet came out today and said that New South Wales will contract by 10% due to the coronavirus and the bushfires and everything else. They're talking about unemployment to jump to 7.75%. And what is fascinating here is that they think that the New South Wales economy shrank by 1.5% in the March quarter compared with a 0.3% nationally. So you've got huge pressure in New South Wales, as you do in Victoria. So I'm worried about these large states where effectively you've got huge pressure with GST revenue falling, with stamp duty revenue falling, with more people unemployed, and all of the factors that are coming together. And they're sort of suggesting that this is going to very much be not just a short-term V-shaped recovery, but a long-term issue that they're going to have to deal with. So expect debts to rise in New South Wales, debts to rise in Victoria, and probably other states too. Another interesting point, this is the Fed's bond buying program. If you want to know why the stock market jumped, 3-something% today in Australia, well, it's simply the Fed announced more bond purchase programs. And they've got this SMCCF and the PMCCF, so that's the secondary market, and then the secondary market corporate credit facility. They love these long acronyms, don't they? And the SMCCFs. So what they're basically doing is they were buying ETFs previously, but now they're going to buy corporate bonds. And they're going to buy them in the secondary market, and they're going to buy them in the primary market. And basically, once they're up and running, the Fed's programs will buy both newly issued debt on the primary market and debt that's already been traded on the secondary market. And the program, by the way, was expanded on April the 9th to include some junk bonds as too. This is nuts, in my view. There was no need for them to announce this. There was no need to expand it further. But, of course, the markets loved it because it shows that, once again, the Fed is coming in and throwing more liquidity into the financial system. They're bailing out Wall Street. Once again, they're bailing out large corporates. In fact, they're bailing out everybody, although less so for households and small businesses. And you have to question now whether in fact the US is really a capitalist country anymore, because the bulk of the economy is now being supported by this bond printing, bond purchase process, right? So the Treasury is lifted their bond issuance. The Fed has been buying those bonds. The Fed is buying corporate bonds. The Fed, if it moves, they'll buy it. So, this is just crazy. And no surprise, therefore, this is the Dow Jones went up a little bit today. But, of course, our markets roared ahead, as did quite a few other markets around the world too, because it shows that the Fed is definitely going to continue to print for a long time. And, in fact, Jerome Powell said he's not even thinking about the question of lifting interest rates. And he's basically said we're going to be printing for a long time, probably 5 years. We haven't seen anything yet. This is mad. It's not going to help. It's just going to create more asset growth. It's going to create more pressure. but won't necessarily hit the real economy very well. But of course, the banks will be fine. So that's good then. So from a financial stability perspective, the Fed is doing an excellent job. But from a real economy perspective, I question whether what they're doing makes any sense at all. And yet, of course, central banks around the world are also following. And in a way, you've got to, because if the Fed, who's got the biggest, ability to create money, is doing it, then other economies around the world are going to have to follow. So this is nuts. This is crazy. This is not going to end well. And to underscore the point, the stock market movements at the moment have nothing to do with fundamental value of companies. It's all to do with all this cash being created, money thrown into the system. It's nuts. But it's going to go on for a long time. Okay, now finally on my scenarios, just to explain off the back of my core market model, I also do have the ability to be able to look at the scenarios. And the scenario is just a way of exploring futures. It's not saying 100% right, but it gives you a bit of sense over time as to where I see things evolving. So this is where the baseline scenario is now. So let's assume the RBA is right and they can keep the cash rate at 0.25%. The unemployment rate goes up and then comes back down to 7%. Mortgage stress stays around roughly where it is. The losses don't come out too hard. In that scenario, despite all the easing, the QE, the fiscal, all of the money that's being thrown at the construction sector, there is a path to home price rises, somewhere between 10% max over the next couple of years, down to 5% drop. So, last time I gave it a 10%, I've had to give it a 20% probability now because they're throwing so much money at it. And now the state of New South Wales is saying they're going to throw more money at it too. We've already seen it in the West, in WA. We've seen it in Queensland. We've seen it in Victoria too. So everybody is throwing money at the construction sector. So if you think about it, that could drive prices up. So there we go. That's one of my scenarios, the RBA baseline. My most what I call my best case scenario. So this is what I think is a more realistic one. I don't think they'll be able to survive on 0.25%. I think they'll have to take the rates lower. I think the unemployment rate will be higher. I think mortgage stress will be higher because I think there are more households who are actually under pressure. I think losses will be higher as well at 18 basis points. And home prices in that scenario will drop somewhere between 5 and 15%. It varies a little bit based on units versus houses and where you are. In Sydney, down 15%. In Melbourne, down 15%, particularly for units. In some of the other states and postcodes, not as much. I give that now a 25% rating. So you can see that that's changed quite dramatically over the last few weeks from 20% last time. But there's also the question of a longer-term crunch. So if this doesn't work, if effectively the pressures on the economy, and particularly on businesses, are more severe, then we're going to see the same low RBA rate. We're going to see unemployment much higher at 8.75% over the next couple of years, mortgage stress higher, losses higher, and in that case, there's still room for prices to drop between 15 and 30%, and I give that a 30% probability compared with 40% last time, and one bank would have significant difficulty with that if that was the case. But then you've also got to consider wave 2. So let's assume wave 2 comes in and we basically see it in the US and we see it in Europe and we see it in other places. New Zealand got a couple of registered new cases today because people are coming from the UK. And we've got 1 or 2 cases here in Australia still in community transmission, and we're relaxing. So it could be we get a second wave. If we do, and as the OECD said, that's a really bad scenario because it's going to kick everything out a lot longer. I think unemployment will be a lot higher. I think the mortgage stress will be higher. Home prices then would actually drop even further. And I give that a 20% weighting, the same as last time. And then if it all terribly spun away and went terribly wrong, uncontrolled pandemic, then you get the massive crisis. I think now that's 5%. I think it's less likely than it was. So there you go. That's my latest scenarios. And you can see there, if you look at it, that really, there's a 50% chance that we're going to be somewhere 5 to 15 in that sort of range. Might be better, might be worse. So that's where I'm seeing things at the moment. And that's based on the latest data coming in from all sources, including the latest data from my surveys. Okay, so with that, we're going to go back to the Q&A and have a bit of a look to see what's there. I'll come to some of the postcodes shortly. Let me just go back down the list and see what questions there are. So there's an interesting comment here from Madeline saying, so MMT is the new normal? Yeah, it's an interesting question that. The view I've got is that ScoMo has basically turned around and said, no, we're going to actually take the situation down. What we're going to try and do is to return to surplus. We're going to, not extend all these payments beyond September, and that's what he said at CD yesterday. The question is whether that's actually conceivable in the light of what I'm seeing, which is actually a more significant issues in the economy than essentially they're suggesting. Now, of course, MMT essentially says, no, governments can, print more money, no probs, because you don't have to pay it back, particularly if rates are low, as long as you are getting more growth out of the back of it than you're actually incurring and actually borrowing. That's the real trick of MMT. And there's a chance with rates so low for so long, and everyone's saying rates are going to be low for 3 to 5 years, that you can perhaps afford to do that. So, but I'm not sure that doctrinally that's where ScoMo is. But there are, of course, many people advocating MMT as a strategy. And I've actually said I think there's probably an argument for more investment to support the economy over a longer period of time, simply because I think that without it, we're going to find ourselves in very, very difficult situations. And all of the data that I'm seeing from my surveys and from other sources are suggesting that this is not going to be V-shaped. And we're going to have to invest more to be able to make it work effectively. And interesting comment from Gary. US is not a capitalist country. You're right. I mean, if you understand that the idea of capitalism was that you take a risk and you get a reward, right? So if you take a big risk, you might get a big reward, but you might lose your shirt. Now, what the Fed is doing is basically saying to corporates and to banks, don't worry, you will never lose your shirt. Let's try and get rid of that one first, shall I? Sorry, and get rid of that one. Yeah, something's gone wrong with my program, I'm afraid. We'll just leave that one there for the moment. Yeah, gone. Okay. Technology, don't you love it? Yeah, so the point is there that the capitalism that was there, it's probably gone away some years ago, actually, if you think about it, but it's got worse now. We don't really have capitalism. We have basically the Treasury and the Fed. Interesting to ask who's calling the shots between the two, basically supporting the US economy and supporting particularly the financial system. And basically risks are effectively now being backstopped by the Fed. So yeah, it's a whole new world. Hi, Cookie Boy. So he says, come on, people, let's get to 1,000. Yeah, well, that'll be good. I think we're close, but not quite there yet. So if you are on and you're liking what you're seeing, just let somebody else know it's on and see whether you can get them to come on and join the party. And Otto says, and he's absolutely right, the financial economy is now completely decoupled from the real economy. That is the point. That is the real critical issue. So we have a real economy that's actually struggling, that's really connected to a lot of the issues that we discussed. And then we've got this artificial financial system being supported with all of these measures. And whilst many people in the financial system and the central banks are worried about financial stability, they're not actually worrying about the real economy, and that's the concern I've got. So all of this stuff is effectively sucking the air out of the real economy. And the trouble is, all the evidence suggests that you end up with a weaker and weaker and weaker real economy as all the assets and all the value flows into the financial system, and you get inflated assets. So stock markets go through the roof, other financial assets go through the roof, but the real economy actually falls apart. I'm afraid that's, could well be the issue, I think. Yeah, and there's a few people saying what this out the blue says Trump needs a war and China is sticking their chin out. There is a concern, I think, as to how this is going to work out from a stability perspective. And you could argue, I think, that there is potentially more and more friction being developed. So I hope that you're wrong, but I think you might be right. And Madeline says, so Steve Kim wins? Well, maybe eventually. So Steve has always said that the debt is unsustainable, but it will be a long time for it to actually work out. And by the way, I think that ultimately the debt has to be repaid. But if you go with the neoliberal view that people must pay, it'll never work. You need some sort of debt holiday, something, to be able to actually release it. So Steve's right on that as well, I think. I'm hoping to get Steve back on down the track, by the way, as well. And there's an interesting comment from DIY. We are technically UBI light now, universal basic income. Well, sort of. I've argued quite consistently that they would have been done better to have done a UBI to get the money direct to households. This idea of flowing it through businesses, through JobKeeper, and getting businesses to flow it on, I think has created all sorts of anomalies. We know that there are a number of corporates who have been very carefully crafting their financial statements with their accountants to get under the hurdle so they can get the money. The question is, will they pass it all on? Have they passed it on? I've got some evidence from some households who were expecting to receive JobKeeper payments from their employer and haven't. So there's a lot of complexity. UBI would have been a lot simpler, but of course probably politically difficult to do. Okay. What else have we got in the comments? There's quite a few. I'm not going to go through everyone. So there's a few people talking about crypto. It's an interesting one. Gen C says, been looking at Irish property bubble, Celtic Tiber, now look with COVID shock like GFC. Do you think we're looking even more like Ireland 2007-8? Yes and no. The difference is, of course, that we have our own currency, whereas they didn't. They had basically the euro. And so the euro basically gave them less wriggle room. And, of course, they compromised essentially and did things that the Eurozone wanted them to do. We have our own currency. Trouble is that our currency is now at 69 against the US, not at 50 or 55, which is where the Reserve Bank would want it. So actually our currency may be working against us at the moment. My own view is it's probably going to come back down a bit because I think we'll see the US dollar strengthen further. But it's tricky because there are many other characteristics, particularly the focus on construction and on the housing sector, which is absolutely the same. A lot of issues with regards to the population and changes in population growth. Remember that we've got no migration at the moment, which is also another negative. So there are lots of things that look quite similar, I think, in my view. Okay, there's more questions about postcodes. I'll come back through some of those. I'll just put that one up, Brian. Thank you. So Brian Cavan says, Stephanie Kelton on TAI 10 a.m. tomorrow, re-MMT. Yeah, Brian, good point. Stephanie's just published a book. It's worth reading. Very powerful in many ways, but also, you have to buy the MMT philosophy or it doesn't work. So it's worth reading and worth listening to what she has to say, I think. Intrepid says, I think Australia should be okay. The Aussie is reasonably stable and we have good swap lines with the US. Yeah, we hardly use those swap lines, of course. I'm a bit worried about domestic debt, though. Well, I'm a bit worried. I'm extremely worried. We've got so much debt in the place that it really is quite troublesome to know what we're going to do with all of that debt. Households are struggling with this debt, right? We know that it's not equally spread across all households. We know there's 20% who are absolutely fine. We know there's another 20% who are very much at the edge or over the edge, and we've got people in the middle struggling. Unfortunately, if the unemployment rate does rise and stay high, those are going to get caught. So I'm very concerned about the domestic debt, but I'm also concerned about the international derivatives and the way that the derivatives are underpinning the financial system. Because one of the reasons why I think the Fed is doing what they're doing is because they're quite concerned about the fundamental financial stability that we're seeing globally. And I think the derivatives sector could still be one of the things that really casts a long shadow, not just Australia, but globally, and could stop the liquidity flows. So we'll have to watch that, I think, as well. It's an interesting comment from Denton. I hope and pray that COVID-19 clusters will be managed locally by states and councils. Yeah, it's interesting, isn't it? I think the most successful stories of managing is when you've got that local capability and basically you track and trace locally and deal with it. Trying to manage it from the centre doesn't work, I think. So yeah, I tend to agree with you. I just hope we don't get too much of that, because of course if you get a proliferation of local clusters and they start joining up, and then you start having to think about what to do. That's why I'm saying that the second wave issue hasn't gone away completely. Okay, what else do we have? This is a very interesting question. So Tremo says, are there second wave or are there second order impacts? Many firms may continue to slash jobs in the months ahead. Yeah, that's the point. That is exactly the point. We know that there are some firms who've actually had quite good inventory of work and have been quite busy up to this point, but that inventory is now dissipating. And so some professional service firms, for example, are in that camp. The construction industry now are in that camp too. And of course, as JobKeeper is withdrawn, then businesses are going to have to make hard decisions about what to do with their employees. How many will they keep? How many won't they keep? What do they do? How do they deal with it? So I think we've got this second wave thing to worry about. Second wave in terms of employment. And in fact, the UK's numbers came out today. They were pretty bad. And they were worried about this as well. So they're seeing a shift into more self-employed people now effectively out of work, a shift to other industry sectors that were doing okay but now aren't. And so whilst retail might be coming back a little, and some of the the other cafes and those things might be doing a little bit better now, these other sectors I think are major concerns. So yeah, I agree, very, very significant. Michael's comment here I quite like. Socialism for the rich, capitalism for the poor. Yeah, it's always been that way, it seems to me. So basically you socialise the losses and you basically pass the profits to the rich. And that's the way it's currently working. So basically every time the financial system gets into difficulty, the Fed and everybody else throws money to try and solve it. Where does the money come from? Well, ultimately, it's taxpayer money, directly or indirectly. Now, you can argue the MMT school and say, it doesn't matter. My argument there is, it does matter. It matters tremendously depending on what you're doing with the money. If you're investing it in productive asset growth and things that will make the economy better and create a better life for everybody, great. But if it's just supporting the financial system, it's not good use of money. So I agree. And Bondi Steve's made the point, world inflation noted in the US is between 5 and 8%. Yeah. How do you calculate inflation is a really interesting question, right? Because the fact of the matter is that the way that calculations are done now are very different from what they were previously. And in fact, if you apply the old methods, then you're right. That's where the inflation is. Probably higher here too, by the way. There's always a fundamental disconnect between what the officially reported inflation is, which is, of course, excluding the cost of housing. It adjusts the quality of goods for the extra functionality they now have relative to previously, so it reduces the cost and a bunch of other things. So lots of reasons why inflation is underreported. And of course, that's part of the issue, right? Because the Reserve Bank is chasing inflation down on a misreported basis. Same in the US, same in most other countries too. It's all part of this same process of effectively driving the economy in a particular direction. And by the way, you could say the same for inflation as you could for unemployment. The measure of unemployment is also incorrect. I don't know whether you saw, I spoke to George Gammon last week, and he made the point that in the 1930s, or just 1929, 30s, in the US, anybody who was employed by the government was counted as unemployed because they weren't essentially employed in the productive sector. And therefore, the unemployment numbers that were quoted then, if you applied the same basis now, then you'd have about a third of the population that would actually be in that category. So the numbers would be a lot much worse than where we were in the US in 1929. And Heath Richards asked this very question, is America going to end up like Japan? Who knows? I mean, Japan is a fascinating case study, and I've had long conversations with John Adams. John and I will hopefully record a show tomorrow, so watch out for the other channel for that. But there's a big debate about whether we've got an inflationary or deflationary future. All of the support that I'm seeing from a Japanese perspective is towards deflation rather than inflation. The Japanese central bank owns about 40% of the total economy. They've been buying bonds and everything else for a long time. In the US, they're heading in that direction. So we could very well see a similar scenario. And it's simply because all of those flows of funds go into the financial system and financial assets, not the real economy. And so you don't get inflation. You don't necessarily get the run-up that you were perhaps expecting or hoping. And so therefore inflation stays very low. Pay goes backwards, costs drop, and then you go into a deflationary spiral. And that is, I think, one scenario that I consider to be quite high probability at the moment. It always comes up in, doesn't it? Gold, silver, neither. Well, why would you buy gold or silver? If you felt the future was going to be inflationary, then it's a reasonably good hedge, because over time gold has tended and silver has tended to hold their value, except 2 points. One, it could be a deflationary future, and as Harry Dent says, in the deflationary future, metals will fall in price, not rise in price, so debate that. And the second is that those commodity markets, just like the interest rate market and the other financial markets, are highly manipulated. So it's not really a clean market. So we actually don't know what the true value of gold or silver actually is. And also remember that gold is at risk of being confiscated. There is a law in Australia that allows gold to be confiscated. So it's not without risk. I actually steer away from gold, silver personally, just my choice, because I think there are too many risks, but others will disagree. Others will think that it's the right way to go. And no, I don't do crypto either, particularly for some other reason. Now, this is a great question, Martin H. What on earth to do with retirement investments? Go conservative, aggressive, growth, funds, such confusing information from all sources. I agree. It is extremely confusing at the moment. And, the classic argument goes, it depends where you are on the age cycle. As you head towards retirement in your 50s and 60s, you should have more conservative structure in your portfolio because you can't take hits. If you're younger, then you should go more aggressive and take more risks because you've got more time to catch up later. That's sort of the official, if you like, doctrine. And then they say spread your assets, so don't put it all in one type of asset. So, a bit of this, a bit of that, a bit of something else. If you've got superannuation funds, a lot of balance funds have a pretty standard distribution right the way through life. So, it might be fine at some stages in life, but not in others. So it's always important to ask the question about what the balance is in the balance fund if you're using a superannuation entity. Remember, of course, those are charging you fees. And in the current environment, fees are huge relative to the returns that are possible. So that's an issue. I've often, and my own strategy has been to go self-managed because I actually want to make decisions. And I've gone relatively conservative because I think that holding cash at the moment, whilst it's not ideal in terms of returns, at least it's less risk than some other scenarios. I may well go back into the markets, but I believe that the financial markets will come back from their peaks. I don't think that it's sustainable where it is, so I'm not going into the markets now. Warren Buffett is also sitting on the sidelines, so I'm a good company. But it is really tricky. And, probably what I would say is that more than ever, it's important to get advice from a good financial advisor, somebody who's got a balanced view of all these things, not somebody who's completely fixated on a particular structural solution, and to try and figure out. But the key question is over what duration, how much can you risk on the downside, how much, do you have to get on the upside to maintain enough to be able to live later? And by the way, most people with superannuation funds don't have sufficient funds to be able to cover them through their retirement, which could be 30, 40 years perhaps. People often forget that. So it's a big question and very, very difficult. The article makes another good point. I think the scale of job losses around the world is vastly underappreciated. Follow the news wires. Jobs are going by tens of thousands. Yes, they are. And what's interesting that it's not just now. Originally, it was the younger people and perhaps the less well-skilled people. Now I'm seeing the job losses accelerate through other sectors of the economy and into more managerial structures and areas as well. I don't think we've seen anything like this. So, the Reserve Bank said this is as bad as the 1930s, or as, worse perhaps. I think that's right. That's why I don't believe that unemployment's going to bounce back anytime soon. And, it might be that we get away with an 8 or 9% peak, although that number is artificially low for the reasons that we've discussed previously. But yeah, I think the job losses, and frankly, the thing I worry about is just the human loss that represents in terms of just the thousands and thousands of people who are out of work. To say nothing of those in other countries where there's a less sophisticated healthcare system and less structured employment. Some of those countries, I think, are going to go through it. Okay. So this is from Sharty Shart. Do you see stagflation as the longer-term outcome for this decade? Well, yeah, personally I do. I'm veering towards the stagflation view. I told you there was this sort of diverse set of opinions. The reason simply because I think all of this financial pumping up is going into the financial system. And as a result of that, what we're seeing essentially is the financial system just getting overburdened. I still think it's likely to implode at some point. Not immediately, because all that liquidity will support it, and the Fed and everybody else will support it. But ultimately, it's not good for the real economy. And unfortunately, the policymakers aren't prepared to take the hard decisions, and therefore, yeah, stagflation could well be what we see. Deflation, stagflation, values of many assets going down. Look at Japan. Property prices down quite a lot from where they were, for example, but the financial system's still bubbling along. Not pretty. Okay, what else have we got? This is a good one. 10-year-olds punting on the stock market. Well, I'll tell you what, the number of new stock trading accounts has never been higher. More people are going into the stock market. They're taking their jobs keeper and throwing it into the market and saying, well, of course, I'm going to ride it up. Seriously, there's quite a few doing that. And, youngsters too. Now, you might be lucky, but I recommend that you watch the show that I recorded with George Gammon. George is brilliant at talking about investing and how to think about investing. And he actually uses some analogies from playing cards. And, basically he makes the point that it's very easy to think that you're actually on a winning streak and then suddenly you're not. And that's the point. So he's got some really good advice about how to think about investing. And I recommend that show if you've not seen it. Big Bang made an interesting question here. Can we benchmark Australia with other countries in the same position? Well, it depends how you measure it. So if you look at the GDP drop, we're probably one of the best so far. If you look at the COVID rates, we're quite near the top. If we look at the amount of household debt in the system, we're at number 1 and number 2, depending on how you measure it. We're behind Switzerland if you look at on a GDP basis. If you look at on other basis, it's actually the highest. So it depends on how you measure it. I think the other point to make is that the measurement is complicated because you're often comparing apples with pears with oranges. And so these benchmarks that people come up with aren't very good. If you look at housing affordability, there's a benchmark that's done on there at the beginning of each year. And most of the housing in Australia, in most postcodes, are very unaffordable or unaffordable. Sydney, Melbourne, and the other major centres. So pretty much wherever you look, we're right at one extreme. Now, of course, we do have the benefit of all that resources that we've got and the fact that we've got the relationship with China. Those things help. So those are also some uniques. And so it's always interesting to try and compare all of these various dimensions and then work out where we stand. So complex, but can be done probably. And Nefi says, Steve's insight, I assume keen, would be very interesting. Yeah, it would be. He's done a few shows. If you search on YouTube, you can actually see he's spoken to a few people relatively recently. He's still talking about the debt jubilee and just handing money out to try and get the debt down. So they're still on that. But yeah, hopefully we can explore that a bit further at some point. Okay, what else have we got? Nico's asked, thanks for this, by the way. Your thoughts on the stock market? I'm hoping it booms. The elite are good at bailing out other elites. Well, I've explained what I'm thinking that's going on with the stock market, and its chances are the market will go higher, but it is disconnected from reality. Remember the old theory that the stock market is about the net present value of future earnings from companies. That's how you value a company. Except no, not now. Nothing to do with that. It's all to do with momentum. It's all to do with it's going to go higher because the Fed's going to throw more money at it. I have no idea how you value stocks in that situation. I really don't. It could be that the stocks are still undervalued. But interesting to see. So in a couple of weeks' time, I'm going to have Damien Classon on from Nucleus Wealth. And Damon, of course, is a fund manager and very expert at thinking about some of these things. So we'll ask him that very question. It could be an interesting discussion. And then I'll come back and look at Concord just a little bit later. I just want to sort of go up to the top here, and then I'm going to do some postcodes. Okay. In fact, let me start with. I'll start with that one, Alan. There you go. So Alan said, "Can you check Concord, New South Wales 2137?" So let me just get that up. Okay. 2137. Right. Okay, let me switch across so you can see it. There you go. And I better take your... Where's that gone? 2137. Yep, get that one off, otherwise we might see it. There you go. So hopefully you can see that. So in that particular 2137, 10,491 households, of which 3,777 are borrowing, 4,197 are renting, and 630 in mortgage stress. That gives a mortgage stress rate of 16.7%. That's quite low. There's a small risk of default at 2.1%, or 80 households, but there's 58% in rental stress, so that's quite high. And overall, in that postcode, including those who are not borrowing, 29.2% are actually in financial stress. There are 3,592 property investors in that particular postcode, of which 1,489 are stressed investors, which is 49.6%, and 291 are severely stressed. And there are 3,228 investment properties. So there you go. That's the latest on that one. Okay, let's just go through a couple of these. So from early on, I had a couple of other people ask questions earlier on. I'm just going to put those in now. Whoops, get rid of that. Get rid of that. Right, so these are Amy's postcodes from earlier on. 2042 and 2048. Okay. Let's go back to the screen. Right. So Newtown and Stanmore were the two. So 2042 and 2048. So 2042. Whoops. Just get that there so you can see it. There you go. So 9,480 households in Newtown, 2,463 borrowing, 630 6,348 renting, 379 in stress, mortgage stress, that is 15.4%, so quite low. Very low default rate, 43 at 1.7%. Financial stress is 39.1, but rental stress is 52.5%. So there's quite a lot of people with rents to pay. And that's relevant because the property investors there are 3,215, of which 1,594 are stressed and 559 are severely stressed, which means that the proportion of investors who are stressed is 67%. So expect to see property investors selling in the postcode, and we've got 4,796 investment properties. In Stanmore, it's 3,561 households, 1,146 borrowing, 2,001 renting, and 115 in mild stress, none in severe stress, so that's 10%, 18 risking default at 1.6%, quite low, but rental stress is high, 61.9%, and financial stress is 38%. Number of property investors, 1,378, of which 889 are stressed, 133 are severely stressed, so 74.2% of investors are stressed, and there's 1,509 investment properties. So that's very significant. Again, I'm expecting to see people with high levels of investor stress struggling to figure out what to do, and in fact they may well end up having to sell. So that's quite a good indicator, I think. I will just do a couple more and then we'll take some more questions, and I'll do a few more in a moment or two. Okay, this is from Amit 3184. And I also got another one from Brendan 4510. I'll just put them up together just to make it easier for myself and on the viewers. Okay, so there you go. Right, let's go back to the PC so you can see it. Okay, so this is 4510, which is Caboolture up in Queensland. 19,457 households, of which 6,777 are borrowing, 10,329 are renting, and mild stress of 333, giving a 4.9% mortgage stress. That's pretty low. 137 risk default at 2%, so that's pretty low. Rental stress 49%, financial stress 27.7%. Number of property investors 6,601. Number of stressed investors 2,063. Severe stress 324 at 36.2. So relative to some of the other postcodes we looked at, it's pretty good. And there's about 8,000 investment properties there at the moment. And in terms of Elwood, 3184, 8,826 households, 2,207 borrowing, 5,833 renting, mild stress 210, severe stress 199, 18.5%, and the risk of default 87 or 3.9%, so that's pretty low, small number at least. The rental stress 19.8, pretty low. Financial stress 17.7, so relative to some of the others, pretty good. I wouldn't say there's a huge amount of risk. So chances are this particular one is going to probably see prices relatively stable, I would have thought. 3,693 stressed investors, however, of which 2,111 are severe stressed. So that's a big number. So that's actually, add those two together, 57% of investors. So it's the investor sector you need to look at in terms of Elwood. There'll be a number of property investors struggling there, and there's 4,409 investment properties in that particular area. Okay, now Liam has said, can I do... I'm sure I can. Let me clear the filter. I'll just leave this up this time. Okay, 4350, which is Toowoomba. Here you go. Okay, now this is, of course, quite a wide area. It includes places like Centurion Heights and you know, lots of others, but a lot of Toowoomba. Big big numbers. 47,136 households, of which 15,734 are borrowing. 23,062 are renting, 10,344 are in mild stress, which translates to 65.7%. So financial stress for mortgage holders, very high indeed. Risking default, 422 at 2.7%. So that's pretty high, but not dramatically high. Default, yeah, it's definitely a risk, but not a huge one. Rental stress, 28.3%. It's not too bad. Financial stress, 35.8. Number of property investors, 10,545. Stressed investors, 2,903. No severe stressed at 27.5%, and there are about 18,000 investment properties in the area. So the critical question here is mortgage stress. Anything above 50%, I get worried about. And so that, to me, is a big, big deal. Okay, what else? I might just do another one. Okay. So this is one from Trutho. It was, clear that. He wanted to know about 5125, and 5127. 5127. Apply. Come on. Apply. Okay. There you go. This is Golden Grove, South Australia, of course, and Windvale, sorry. So 7,574 households, of which 4,380 are borrowing, 2,348 are renting, 2,666 are in mild mortgage stress, none in severe stress, but that's 60% in mortgage stress. That's a big number. Anything above 50%, I get worried about. And remember, the average nationally is 38%, so that's bad. Default rates, 2.7%, 120. 2.7%, that's reasonably high. Remember that the national average is about 1.5%. Rental stress, 5.9%, doesn't look too bad. Financial stress overall, 37%. That's a cash flow issue, I think, for those who perhaps don't have particular commitments relating to mortgages, for example. Number of property investors, 3,201. Stressed investors, 231. That's only 7.2. And the number of investment properties, 1,745. So there you go. So mortgage stress is the thing to look about there. I think a lot of households will be in significant issues. And when I calculate stress, I'm looking, by the way, at the latest information, including rent, including job seeker and job keeper. Okay, young growing families at Windvale, 3,176 households, 1,725 borrowing, 883 renting, 1,460 in mortgage stress, no severe stress, but 84.6% in mortgage stress. This is a really big number, 84.6. A lot of people will be under financial pressure in that particular postcode. Risk of default, 55 at 3.2% over the next 12 months. Again, looks pretty dodgy to me. The overall financial stress is 46%, 1,633 property investors, 233 stressed property investors at 14.3%, and the number of investment properties 691. So the real issue again there, and it's a bit similar to the other one, mortgage stress. Ease your problem. Okay, there we go. Now let's do another one. Whoops. Clear this. Okay, so what have we got? Coleroy, 2097. Just saw that one. 97, add. Apply. Okay. All right, Coleroy, New South Wales, 5,699 households, 2,686 borrowing, 1,873 renting, 215 in mild mortgage stress, 203 in severe mortgage stress, 15.6%. So doesn't look too bad from a financial perspective for those with mortgages. 97 risking default at 3.6%, so there's still a bit of default risk, but it's relatively contained because the numbers aren't great. Rental stress, 30.8. Financial stress, 17.4. 2,035 property investors there at 988 with stressed investments, 29 severely stressed, that's half. So half of property investors in Coleroy are in financial pressure, and the number of investment properties there are 1,432. Okay, so I'm going to break off from doing postcodes for just a little while and just look at some more comments and see where we are. Let's go back up to there and then work down the list a bit. Okay. Lots of postcodes. I don't promise to do all the postcodes because it's just quite painful, but we'll do a few more, I promise. George, he's talking fast, my short hair can't keep up. Good news is this show is actually on replay afterwards, so you can always go back and play it again. Nico said, take your super payout and run for the hills. Yeah, well, a lot of people doing that. About half the people who've taken super out, averages more than 7,000 something now, dollars that is, don't have financial pressures, according to my stress anyway. Okay, what else do we go? Okay, Dick Colleroy. That's an interesting comment. I'll just look at that one. So this is from DIY. In Melbourne, Iceland, a single mum bought at 44k in 2004, saw repayments shot up to 80k in 2009. Well, yeah, there's a lot of complexity in terms of where things go. Remember that with rates so low at the moment, they will stay low for a period of time, but eventually they will rise. When they rise, those big mortgages will really bite. So it's not good. Okay. All right. Well, looks to me as though all of you want more postcodes. Okay. If you don't answer me other questions, this is a good one. I'll just pick on that one. Thank you. From Shari, I reckon everyone should closely check their taxable income when lodging. If businesses take the job keeper, don't pay you, but they say they'll make a killing. Yeah, it's a really complex audit question, and I don't know what the ATO is going to do about it. Excuse me, because of course it was all set up quickly. That's one of the reasons why I think UBI would have been a much simpler way to do it personally. But there you go. It's going to keep people busy for years. Oh, more job creation. Beer ATO, of course. That's the way to solve the problem. Okay. Gold Nugget says, don't go near the Brisbane property market. Units particularly, I would say. Avoid units in and around the centre of Brisbane. There's a lot of spare capacity there. More being built. Also be careful of units on the Gold Coast. Houses are a little bit easier because there's less supply and probably more demand. But units, I agree, be careful. All right. Well, it looks as though we're going to do postcodes because everyone's asking me about postcodes. So I'll just pick a few more. Mark, you asked for this one. 3193. So let's just put that in my editor. I should say that I'm talking to a couple of people about automating this process so that you might be able to get this information without having to ask me directly. So watch this space. We'll see what we can come up with. But it's also quite fun, and I can give you my opinion as we go as well, so it sort of helps. Oops, get rid of that mark, otherwise you won't be able to see it, sorry. There you go. There we go. 3193, 8,027 households. This is at Blackrock Cromer, 3193 in Victoria. 3,227 borrowing, 2,226 renting. Sorry, 2,265 renting. 161 in mortgage stress. Nothing much there. 5%. Risking default, 115, 3.6%, bit higher. 52.2% rental stress. 16.7% financial stress. 2,919 property investors, 862 stressed investors, 33 severe stressed investors, 30.7% investors stressed, and 1,727 investment properties. So there you go. That's another one. Let's see what else we've got. This is from Bedders, 4034. Sure, no probs. $4034. I'm going to learn my postcodes by doing this, by the way. Whoops. 4034. Try again. Come on. Apply. There you go. Get rid of that so you can see it. Okay, 4034. So this is Jibong doing Apsley, Zilmere. 18,446 households, 7,167 borrowing, 7,803 renting, 5,603 in mild mortgage stress at 78.2%. Very high levels of mortgage stress. 150 risking default at 2.1%, 33.8% in rental stress, and 44.7% of households in financial stress. So quite a few older households there, not necessarily borrowing, also with financial difficulties. 3,106 property investors, 539 stressed investors, which turns into 17.4%, and 5,932 present properties in the place. And there you go. Okay. Mark says, did I do this one? Don't think I did. 3193. Okay. 3193. Apply. Come on. Okay. 3193. Get rid of that. Right. So 3193 is Cromer, BlackRock, Victoria. 8,027 households, 3,227 borrowing, 2,265 renting, 161 mild stress, 5% in stress. That's pretty good. 115 risking default at 3.6%, not so good. 52.2% in rental stress, above 50%, concerning. 16.7% in financial stress, 2,919 property investors, 862 stressed investors, 33 severely stressed investors at 30.7%, and 1,727 investment properties. So there you go. Another one here. Justin, can you cover Somerville? 3912. Give it a go. I'm sure one day I'm going to get a postcode that doesn't exist. But anyway, we'll cross that bridge. I'm not sure what happens if I put a postcode that doesn't exist. I've never tried, but hopefully it won't break the program. Because this is tapping live into my core market model, you see. This is the way it works. So I'm just running a query on the front end. 2912. No. 2912. That's what you wanted, yeah? Yeah. Okay. Let's get rid of that so we can see it. Somerville, 5,710 households, 3,341 borrowing, 1,579 renting, 647 in mild mortgage stress, none in severe stress at 19.4%, 76 risking default, 2.3%, 58.3 in rental stress, 27.5 financial stress, 1,790 property investors, 294 stressed investors, severely stressed at 53 at 19.4 investors stressed, that's percentage, and 1,189 investment properties. Okay, so what I'm going to do now at 9:25 is I'm going across to the other chat. I'm going to go here and just go down the list for those who've actually chipped in a few dollars. Thank you very much for that. I really appreciate it. Chizia, you've asked for 3. Stretching my favour a bit, but we'll see what we can do. Let's have a look. What are the numbers? Okay, 3038. Yep, got that one. 3023 and 3037. Okay. So these are all Victorian outer suburbs. Altona Meadows, 3028, 11,388 at 4,695 borrowing, 4,466 renting, 1,174 in mild stress, none in severe stress, 25% in mortgage stress. 117 risking default in the next 12 months at 2.5%, rental stress 29.8%, financial stress 22%, number of property investors 3,969, number of stressed investors 692, 120 severely stressed 20.5, 3,433. So, not too bad compared with some of the others. Burnside, and this is 3023, 20,065 households, 12,481 borrowing, 6,771 renting, 1,823 in mild mortgage stress, none in severe stress, 14.6%, 262 risking default over the next 12 months at 2.1%. There's 61.5% in rental stress, so that's a big number, above 50%, worries me. 29.1% in financial stress, 6,433 property investors, 1,601 stressed investors, severe stress 175, meaning it's 27.6% of investors stressed, and there's 5,218 in the postcode. And then the last one there, Sydenham, 3037, 16,434, that's the number of households, 10,507 borrowing, 4,643 renting, 6,839 in mild mortgage stress, so that's 65.1% in stress. That's a big number. 253 risking default, 2.4%. It's quite high. 48.4% in rental stress, 55.3% of households in financial stress overall, 4,834 property investors, 827 stressed investors, 52 severely stressed investors, 18.2% of investors are stressed in the postcode, and 3,520. There you go. Okay. Nico, I think we've discussed the stock market sufficiently. I'm not going to cover that one again. I think I did Concord, didn't I, Alan? So I hope we've got that one. Thank you very much, Her Money, Her Purpose. Appreciate that. Thanks for the content, Mr. AB. Appreciate that. Reverse French. Thank you. Vive la Republic. Love it. Brendan Steele. Thank you very much for that. Emma Mum. Thank you very much. Organic food. Love your work. Interest in postcode 4000. Can you differentiate the house versus unit? Oh, come on. Rob you. Not in this model. I do have other data. But trying to do that would be quite difficult. I certainly can't do this in this model, but I can give you 4,000 as a summary level. Of course, that's Brisbane, isn't it? Let's see what... Okay, there's Brisbane. Yep, there you go. So 8,674 households, 1,627 borrowing, 6,432 renting, 217 in mild mortgage stress, none in severe stress at 13.4%. Risking default, 38, 2.3%. Rental stress, 45.5%. Financial stress, 36.2%. Number of property investors, 2,662. Number of stressed investors, 1,344. Number of severely stressed investors at 264. Investors stress, 60.4%. And that relates to 4,973 properties. So, a lot of property investors in the CBD are under pressure. Mortgage stress, not too much of an issue. I think I did that one, Liam, with Toowoomba. Viewbank, says Trone, 3084. 3084. Let's do that one, shall we? Nearly coming up to 9:30, so we'll do this a bit more because I find this quite relaxing, really. 3084. Just remind you, for those who might be thinking of disappearing soon, that Robbie Barwick will be on next week. Robbie will be talking about financial system, what needs to be done in terms of regulation, all of those sorts of things. Very, very important show. He'll be on live, so you can ask him questions. You can ask about bail-in. You can ask him about derivatives. You can even, if you really want to, ask him about China, I suppose. Okay, this is 3084. Households. This is in Heidelberg, Viewbank in Victoria. 10,525 households, 3,986 borrowing, 3,701 renting, 2,308 in mild mortgage stress, none in severe stress, 57.9% in mortgage stress, 80 households, risk default, 12 months, 2%, 18.2% in rental stress, 28.2% in financial stress, number of property investors, 2,663, numbers of stressed investors, 364, number of severely stressed investors, 14.19, so that's 14.4%, and 2,818. So that tells me that that's a reasonably interesting postcode where the investment sector is looking okay, but mortgage stress at 57.9% is well above the average, and that looks to me to be at significant risk there, which is why the default rate's at 2%. So I'd be a bit concerned about that. Anita said, thank you very much for that contribution. You need more $ to keep up with the QE. I love it. Great. 4061 says David 811. Uh, 4061, right? Okay. Yep. The Gap, Brisbane. 6,056 households, 3,221 borrowing, 1,283 renting, 248 in mild stress, none in severe stress at 7.7%, 69 risking default in the next 12 months, 2.1% risking default, rental stress very low at 4.8%, financial stress at 5.2%, 900 property investors, 49 stressed investors, 5.4%, and the number of investment properties 1,062. So, my read on that is, looks a pretty good place relative to all the others we've seen. That looks quite well. Oh dear. Shinzo said, you did 3038 instead of 3028. Can you do 3038? Sorry, you expect me to read as well? Whatever next? Oh, of course I will. Sorry about that. I get my 2s and my 3s muddled up. Can I do 3038? 3038. Apologies. I'm sure that somebody else enjoyed that postcode. Taylor's Lakes. 3038? 3038. Yep, okay. 9,479 households, 4,213 borrowing, 2,287 renting, mild stress, 2,760 at 65.5%, so that's quite high. 107 risking default, 2.5%, quite high. 39.1% in rental stress, not as high as some areas. About average, just about there. 38.6% in financial stress, 3,482 property investors, 604 stressed investors, 36 severely stressed investors, 18.4% investors are stressed. That's low relative to others. And the number of investment properties, 1,765. So I think the answer there is mortgage stress. Look at the household side for mortgages rather than property investors. There you go. I think I've covered all of those. And thank you all of those who've made a contribution to tonight. I really appreciate it. Let me just pop back to the other chat. See what else we've got. All right. So I may have missed some. I apologise. I've got quite a few that I didn't get around to. It's always the way, isn't it? That's a good one. So Cookie Boy, let me just go back to my other camera, main camera. There you go. Cookie Boy said, I might post a video on Twitter showing a walk through a shopping centre. Might do Roos Hill. Yeah, it's very interesting. If you've gone into some shopping centres, there's some weird stuff going on. There's a few that are quite busy. Social distancing a problem, but still a lot aren't. Lots of empty properties, though. Lots of empty retail. I think the retail sector is definitely up for a problem. Go away. Thank you. Okay, can I check 3174 from Jukebox Insider. Sure. Okay, clear list. 3174. Apply. Come on. Engage brain. Yeah, there you go. This is Noble Park on the urban fringe of Victoria. 3174. 14,819 households. 5,049 borrowing. 7,195 renting. 1,866 in stress. None in severe stress, that's 37%. So that's a bit below the average. 115 risking default at 2.3%. 54.6% in rental stress, 39.1% in financial stress, 3,566 property investors, 820 stressed investors, 191 severe stressed investors, 28.4% of investors stressed, 5,463 investment properties. So I think you can pretty much see the story there. It's all about what's happening to the rental stress sector. That's where I think the pressure will be. And I haven't put that up so you can't see it. Hang on, let me just push up out the buttons and hopefully I'll... dear idea. Hang on, let's get rid of that. Yeah, okay. And then I'm just going to go to the PC. Sorry, I realised that you couldn't see it. I'll leave that up for a second. So this is Noble Park, 14,819. And 37% of people in mortgage stress, 28% of investors stress. So the mortgage stress stuff is the most significant, I think. Okay. So what I'm going to do is I'm going to go back to the presentation. I'm going to finish off the rest of the presentation. And then right at the end, if you're still with me, I'll do a few more postcodes before I finally sign off. I think that's the way to do it, because there will be some people who probably will think it's about time to move on. So just in terms of a few more slides here, just to say, if you want more information about what we do, there's the DFA blog. The DFA blog has a lot of information on it. It gives a post for every post that we make, podcast as well, and other articles. So sign up there, you can get alerts. Recommend you do that. Also wanted just to highlight the fact we have our Patreon channel as well. There are different tiers of membership. I've added a new one, which I've actually called Get a Copy of the DFA Mortgage Stress Data. So if you want a extract of all of the stress data for a month, like I've been showing you, but for every postcode in Australia, you can get that now, $50 a month if you join that tier, and that's available. And there's basically different tiers from $500 a month to get all of the data. This is US, I should say, down to other tiers. So if you want to support us on an ongoing basis, Patreon is actually a really good way. We make no profit from doing this. This is just simply to cover our costs and to allow us to do what we do. Or PayPal, if you want to make a one-off donation, you can always use PayPal. A few people do that. Very simple, very straightforward. So that's there as an alternative too. And PayPal me, Martin DFA. Or Bitcoin even. There's a QR code there for those who are Bitcoin orientated. I was asked for that some time ago. Not very many people use it, but it's there if people want it. There is a DFA design. This is the one I came up with today, and you can actually get it on some merch. Now, I know the merch is relatively expensive because, of course, it's in US dollars and it's produced in the US, but had a few people go for it. If you want, some unique contributions from DFA, then essentially the merch's there, and there. Have a look at them if you were interested. I did it just really because I could do it. So, but as I say, I have got a few people who've gone for it. So. Recent posts. I just wanted to highlight the post I did with Tarek Brooker called The Eye on the Storm. That's now within the top 25 all-time hits. It's only been up for 2 or 3 weeks. So if you've not seen that post, go look at it. It's really quite powerful. I did another one with Tarek yesterday called Job Killer Arrives Early. I coined Job Killer as essentially what the ScoMo strategy really is. So watch that post if you've not seen it. I've got a few from Salvatore Babones. He's associate professor in the University of Sydney. He spoke with me about the American paradox and the violence and what was driving it. I think he's really quite interesting. He's very pro-US, of course, because he's an American, but nevertheless quite interesting points. I also had a chat with Steve Mickenbecker from CanStar talking about the pressure on depositors. That got to a good play. And of course, George Gammon. If you've not seen the George Gammon episode on investing and why you should invest, have a look. It's a really very powerful post. I think George and I had great fun making it. And then, of course, my daily posts, Sell While You Can, which essentially was me talking about this disconnect between the real world and the financial world, and what was driving it. Got a huge response, so I appreciate that. And I just want to say, if I may, thank you for your support, because we've now got more than 40,000 subscribers, which is amazing. Who'd have thought that over 18 months or so we'd have been able to achieve that, or maybe slightly longer now, not sure. Started 2 years ago, maybe. I'm not sure now. Time flies when you're enjoying yourself. But I just want to say thank you very much for supporting me. Please share these posts. Please, use your social media channels to spread the word, because I think the discussions we have here are very important and hopefully balanced, but hopefully also quite entertaining. And we've got a lot more content planned, more guests, of course. I've mentioned Robbie and also Damon Klassen from Nucleus Wealth. I've got some other people planned as well, so watch out for that. And please spread the word, because I want to get 50,000. 50,000 by the end of the year is my target now. We'll see whether we can make that. And there's Robbie. So it's just worth highlighting the fact that Robbie is up there. And I guess the point about this is that you can ask him live about bail-in, and you can ask him live about some of the other things. Not least, where is the bail-in legislation? Where is the legislation relating to the National Bank? Those are the two things that they're shepherding through quite hard. So I think it'll be an interesting conversation, and don't hold back with the questions. I'm sure he'll be more than happy to give you some good answers. So that's essentially that. And I'll just go back to the main camera. Okay. So, let's put that there a minute. I need more screen space than I've got. So I just want to say thank you for all of those who have supported what we've done, and the contributions that you've made also has been very helpful as well, in terms of just helping to keep everything going. I will do a few more postcodes before I finally sign off, and there's one there which I'm not sure whether I did. Not enough SA data unique, I'd say. 5125 says Damien. I'm not sure I've done that one, so let me do that one now. Clear list. 5125. Add that. Apply. Okay, right, put that one back on. There you go. So this is 5125, Golden Grove, Greenwith, 7,574 households, 4,380 borrowing, 2,348 renting, 2,616 mild stress at 60.9%. So high mortgage stress, average across the country, 37.5, remember. 120 risking default at 2.7%, that's a bit above average. 5.9% in rental stress, 37% in financial stress, 3,201 property investors, 231 stressed investors, 7.2% investors stressed, 1,745. So there again, mortgage stress is the critical issue there. 2142 MP says, have I done that one? Probably not. I'll do it anyway. I guess the point where I don't remember which ones I've done, because I've done too many of them. 3142, 3142. So hang with me. I might get to your postcode. I don't promise to. Turak. Ooh, interesting one. Yeah. 7,087 households. 1,563 borrowing. 3,666 renting. So very strong renting. Nobody's in mortgage stress. Affluent postcode, maybe you'd expect that. 72 risking default, though, at 4.6%, and that's because of the fact that those have complex financial relationships. A lot of people in that particular postcode, they're more affluent households. They tend to be owning multiple properties, all those sorts of things. 17.6% in rental stress, 9.1% in financial stress, 1,772 property investors, of which 443 are stressed investors, 21 are severely stressed at 26.2%, and there are 2,788 investment properties. So there you go. That's Turak for you. Okay, so I think we've done all of those. Let me have a look, see what else. Vita Percy says Narrabeen. Did I not do Narrabeen? Okay. I thought I did. Maybe I did. Maybe I didn't. I'll do it again. 2101. Maybe that was last time. 2101. Just keep asking if you haven't had your postcode done. Keep asking. 16,106 households. 3,339 borrowing. 11,880 renting. 317 mild mortgage stress, 599 in severe stress, 27.5% in mortgage stress, 74 risking default at 2.2, 60.4% in rental stress, that's a problem, 50.2% in financial stress, 4,983 property investors, 3,116 stressed investors, 633 severely stressed investors, 76.2% investors are stressed. Okay, there you go, interesting issue. So a lot of property investors, not necessarily with properties in that postcode, but have issues. And there are 8,913 investment properties in the postcode. There you go. That's that one. Right. What else have we got? I'll just come back to there. Okay. So let me just go back down the list and see what else there is. Though Greg Elson says Monavale, 2103. Sure. Two 103 plus apply. Okay. So we'll get rid of that and we'll go to there. Okay, Monavale, 4,353 households, 1,603 borrowing, 1,540 renting, none in stress, pretty good, 75 risking default, 4.7%, 42.9% rental stress, 15.2% in financial stress, 1,297 property investors, 442 stressed investors, 55 severely stressed investors, 38.3%. Number of investment properties, 1,166. I should just add, this probability default, this of course is taking account of a lot of externalities as well as what's going on. So that's one of the reasons why you can have no stress but still high levels of default, because there are some externalities that could impact particular households. And that's based on some data that I've got from quite a long period. Okay, so I got Glebe 3067 from edit filter, clear list, 2037, 2037, Glebe. Okay, there we go. 8,354 households in Glebe, 1,520 borrowing, 5,978 renting, 253 in mild stress, 479 in severe stress, at 48.8%. So that's above average. 38% risking default at 2.5%, around average, a bit below, a bit above, I should say. 71.2% in rental stress. That's a bad number. A lot of people struggling. 59.7% in financial stress. It looks that's a pretty dodgy postcode, this one actually. 2,066 property investors, 1,200 stressed investors, 311 severely stressed investors, 73.1% investors stressed, and 4,595 investment properties. Ooh. So both property investors and stress is high. Expect prices to go down in Glebe. I'm just going to answer this question because I think it's quite an interesting one. This is from Damien. Thinking to buy in 5125, cash buy, but my question is timing in general. Keep up the good work. Timing is the really interesting question. Where do you think employment's going to be in 12 months, 18 months? Where do you think property prices are going to be in 12 or 18 months? That's what you've got to ask yourself. And are you buying for own occupation or for investment purposes? Frankly, if I'm buying for investment purposes, I probably wouldn't at the moment. I'd wait. If I'm buying for own occupation because I want somewhere to live and I want bricks and mortar and it's a good price and I can afford to take a hit if prices fall, then timing is more flexible. You can get huge finance deals that I showed you earlier on with very low rates, but it's quite tricky. So timing is really tricky. I don't think there's any rush at the moment. One of the things I keep saying to people who ask me about what's going on, I said, look, I don't know. Nobody knows. Chances are it's going to take a long time to play out. Very unlikely that we're going to see massive price rises because even the most bullish people are talking, 10% over 2 years, or maybe 15% over 2 years if you're very, very lucky. I mean, it's not a huge run up, and there are so many risks to the downside. So I would say, just relax. I know that's easy for me to say. Okay. Oh dear. I knew this was going to come up. I like Barwick, but can't trust him on China. Well, you don't have to agree with everything he says. The whole point about this is you have different views and opinions on the DFA channel. It would be so boring if everybody had the same views and same opinions. So, just roll with it. It's all part of spreading a broader perspective. So my strategy on DFA is to give you a range of different views and opinions. There'll be some common linkage to them, but it won't always be precisely the same. I think this is a good one. Plexus says, as long as it's civil, all ideas are welcome. Absolutely agree. Yeah, that's the point. I think this is hopefully a civilized environment to have conversations about things. Thank you very much for that. Okay. I'm going to do just a few more and I'm going to run out of smoke. So if you didn't get your postcode, I apologise. There will be another opportunity, and I'll tell you another way to get the information if you weren't successful getting it on the live stream. Let's do this one. 3048. 3048. Apply. Come on. 3048 is Meadow Heights in the urban fringe of Victoria. 5,772 households. 2,606 borrowing, 2,452 renting, 1,036 in mild stress, none in severe stress at 52.2%, 54 risking default at 2.1%. That's lower than some others we've seen. And I realise you won't be able to see what I'm talking about. Hang on. As you were, 5,772 households, 2,606 2,452 renting, 1,360 in mild stress, none in severe stress at 52.2%, 54 risking default at 2.1%, which is lower than some, 76.7% in rental stress, oh that's bad, 56.1% in financial stress, 1,789 of property investors, 504 stressed, 101 severely stressed at 33.8%, 1,860 investment properties. The key point there is this mortgage stress and this rental stress. Rental stress is critical because it's going to hit investment properties. And, one of the things I keep saying to people is that the whole point about rental stress is you've got to understand this from two perspectives. The first is what those renters are going to do, but secondly, what the property investor is going to do as well. And unfortunately, rental stress, property investment are two sides of the same coin. So that's why I look at both of these dimensions. Okay. Can I fit in Mandurah? Says Ben. Sure can. My favourite postcode, as you know, I've been studying Mandurah for quite some time. It's a very, very interesting postcode, and it's a very much an example of what I think may play out more broadly. So, of course, I will do Mandurah. Consider it done. There we go. I'm just going to get rid of that and get back to there so you can see it. Okay. What? Oh, that's right. 6210. Yeah. Okay. So of course 6210 is Mandurah and a bunch of other places too, like Meadow Springs. But anyway, 35,104 households, 11,891 borrowing, 17,691 renting, 3,348 in mortgage stress, which is 28.2. Risk of default. This is the scary one, 698 or 5.9%. So this is now worked through to the point where people are effectively very much looking to fall over. Rental stress, 25.1. Financial stress, 22.2. Numbers of property investors, 11,343, of which 2,943 are stressed, 241 are severely stressed, 28.1% of investors are stressed, and there are 13,540 investment properties. So on one level, you could say, well, hang on a moment, that looks pretty reasonable. Mortgage stress a bit lower than places. Yeah, but they've gone through the rinser, right? So effectively, they've gone through this whole process. We've got people who've already been foreclosed. We've got a lot of people in negative equity as well, by the way, which is a different measure, which is not one I've got in this model at the moment. So, but the critical one is 5.9% risking default in the next 12 months. That's a horrible number. And on that basis, I would expect property prices to slide further in Mandurah at the moment. Vita Percy. Oh dear. I think I'm either dyslexic or I'm just tired. I did 2010 instead of 2101. My apologies. Oh dear. Going to have to find a better way to do this, aren't I? 2101. Apply. Okay. Narrabeen. There you go. Got it. Now we just get rid of that so you can see it. 8,015 households, 3,071 borrowing, 3,349 renting, 114 in mild stress, none in severe stress, 3.7% in mortgage stress. That's very low mortgage stress. 122 risking default at 4%, so high levels of default for externalities. 36.1% in rental stress, 16.5% in financial stress, 3,380 property investors, 1,710 stressed investors, 204 severely stressed investors at 56.6. Wow, that's quite high. So 2,513 property investors, property investment properties there. But this is not so much about mortgage stress. This is about investor portfolios and investor stress. And that's the problem. So I wouldn't be surprised to see some forced sales coming out of that postcode as a result of it. As I keep saying, of course, that you can have high levels of stress in that postcode for investment, but they actually have properties in other postcodes, right? So it's not necessarily in that postcode, but it puts financial pressure in people in that postcode, so they spend less and do all those things. So that's part of the picture. Okay. And Vincent says, Mandurah's bad. Still more carnage to come. I'm agreeing. Yeah, unfortunately. I watched the stress build over the last 4 to 5 years there. Reached a peak. Then I started to see all of these things fall apart. Prices dropped. Social issues rose. People got forced out. It's all the story, I'm afraid. Okay, a couple more. Can I do Wentworthville? 2145. Sure can. Two, 2145. Add that. Apply. Okay. Get rid of that. And go back to there. There you go. Wentworthville, Westmead, all that whole area, 27,856 households, 10,997 borrowing, 13,021 renting, 1,764 in mild stress, 196 in severe stress, 17.8% in mortgage stress, 168 risk default at 1.5. So that's actually much lower than quite a few. But look at this. Rental stress, 62.8%. Financial stress, 36.4%. 10,700 property investors, 3,940 stressed investors, 985 severely stressed investors at 46%, and 9,809 investment properties. So what you're seeing there is not so much mortgage stress as the investor stress, and that's what we're seeing. There you go. That's that one. Nice comment here from Marmon. Just to show how much inflation has affected us in the last 20 years, young people had no choice in this rigged scam and no wage growth. Older people are still paying people 25 an hour. It's a very inequitable situation that we're in. And unfortunately, it's partly engineered by this fixation on property expansion investment. So we know that the government has been throwing money for years and years. The banks have been throwing money for years and years. That's what's created this horrible disequilibrium, unfortunately. And I don't see a clear and simple way back, unfortunately, from it. And that's part of the issue, right? Because it really is now to the point where property's got such a large proportion of the economy, it's very hard to wind it back. All right. Intrepid asked, what do you think banks will do? Do you think banks will be okay with the current trajectory of mortgage stress? Well, you heard what I said earlier on about them saying, no, there's no issues, right? So we can manage this through. They will try their best not to allow prices to fall, not to allow stress to turn into delinquency and default, because it's the last thing that they want. The question is, do they have the firepower to do it? Well, they certainly have the capital in the short term. But if this goes on and gets worse, they potentially will have issues. But I think they'll be buttressed by the government. So my view has been for some time that the banks will probably be fine, because just like in the US with the Fed, they will be supported by the central bank. More QE, more money, and that may be sufficient to stop them from falling over. And remember, my scenario said there's a risk one could fall over, but the chances are it'll be bailed out. My view is therefore that they'll be supported by the government, and bail-in therefore is probably less relevant than it was a few months ago. All right, well, it's 10 o'clock. I think I've done my dash. So I want to say thank you very much for spending some of your evening with me. It has been a privilege for me to talk with you. If I didn't get to your particular postcode, I apologise. If you want to get that information, you can still send me a message via the DFA blog, and I will try and respond to it. I notice, Kedler, you've just put a question in there. I might just give you, because you've actually made a contribution, let me just answer that before I go. Clear the list, put those two in for you. 2153 and 2151, because you made a quite an interesting spin on the question. So let me just do that. There you go. Okay, so this is North Parramatta and Balcombe Hills, and you can see there that in Balcombe Hills 19,413 households, 10,603 borrowing, 4,874 renting, 2,903, 27.4 in mortgage stress, 182 risking default, 1.7% default over the next 12 months, not too bad. 67.6% though in rental stress, 32.9% in financial stress, 6,018 property investors, 1,324 stressed investors, 391 severely stressed investors, and 28.5% investors stressed, with 3,716. So that's the critical one, rental stress, 67%. And in fact, it's quite high over there in North Parramatta, North Rocks as well. 8,348 households, 3,054 borrowing, 4,327 renting, 1,470 in stress at 48.1%. That's high, much higher than the other one. 62 or 2% risking default next 12 months, 62% in rental stress, 49% in financial stress, 51.1% of investors stressed, and 3,237 investment properties. So signs of stress in that particular postcode. Now, in terms of your question, can I buy a first home rented for 2 years? I would say to you, don't panic. I would say to you, hold your firepower. I think prices will be lower ahead. I think you'll probably buy better. I don't see any urgency at the moment, particularly if you are able to rent. Rents are coming down, so you can probably pay less rent. So that would be my view, but who knows. And Aaron, thank you very much for your contribution. I really appreciate it. All right, so there you go. That's it. For those who have not been successful in getting their postcode up tonight, as I say, send me an email or in fact go to the DFA blog, and you can use the contact app there on the blog and send me, and I'll try and get back to you over the next day or two. I'm sorry that I didn't get to everybody. I've got way too many. But I thank you for your time this evening. I hope you found that interesting and useful. I will just highlight again, one more time, that Robbie Barwick is due next week, and Robbie will be there to talk about financial legislation, derivatives, all of those things. A very interesting conversation. What are the risks in the financial system and all of those things? So mark that in your diary. And the following week, because it's a 5-week month, we've got Damien Classon there as well. So that'll be fun as well. So thank you very much for your time today. Thank you for your support. Thank you for all of those who've been retweeting and essentially spreading the word about DFA. Keep doing that. Keep supporting what we're doing. I'll read your comments with great interest on the blog, and also on the YouTubes, and also on Twitter as well, if you follow me there too. So thank you very much. Take care. Have a good evening. Keep safe, and we'll see you next time. This is Martin North from Digital Finance Analytics, signing off.